Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Discovery Inc., ticker DISCA. This is a company that we are going to cover both the valuation and the business quality over the next few minutes. First up, we look at market cap, $12 billion, enterprise value, $22 billion. That means you have about $10 billion in net debt on this business. That's a significant amount of leverage. So I expect we're going to be looking at stuff like interest expense. It is a media business, so those aren't uncommon to have a lot of debt, but still, this gap suggests not only is there a lot of debt, there's probably some uncertainty in the value of the equity because of it's so low compared to the debt load. About half and half is quite strange to see. Discovery is a media company that provide content across various distributed platforms, 50 languages worldwide, 2 segments, U.S. networks and international, has various brands including Discovery Channel, HGTV, Food Network, TLC, Animal Planet, Investigation Discovery, Travel Channel, Science, Motor Trend, and various others, Oprah Winfrey Network, Discovery Kids, Discovery Familia, Euromax. So quite a number of brands. I've certainly heard of quite a few of these, but these are basically different television networks all under that. So they're selling, television content. The beta is 1.1, nothing significant there. Let's look on return on capital. Return on invested capital. The first thing I notice is that the company appears to be a little cyclical. And somewhat unpredictable. You see years of losses here. I want to know how many years of losses in the last 20 years they have. That gives me some idea of how many years of losses I can expect in the future. And I can see 1, 2, 3, 4, 5 years of losses in the last 20 years. So that means for 25% of the time, I should expect the company to lose money. And that's not really good. What it means is that the average return on invested capital that you have is actually going to overstate the returns you should expect as an investor, because you have to average in negative losses, and the way that geometric returns work is that the arithmetic mean is going to be higher, appear higher than the geometric mean, and so you're going to have some problems with compounding issues. Once you lose money, that really messes up compounding. Now, you can see almost like a golden period for this company from 2008 to 2016. You start at 4% return on invested capital, you end the decade at 8%, but you pretty have steady growth, 4%, 5%, 6%. You get up to 10%, come back down to 8, 8, 8, 8. Or 7, 8. So especially this 5-year period from 2012 to 2016 looks really good. But probably since 2016, and this is going to be the period where, cord cuttings become an issue, they've been losing money in 2017. They started to get poor returns. And so the last 2 years at 4% and 3% return on invested capital is quite low. You don't like to see that. And that tells a future that there's potentially low returns for shareholders. So I don't like what I'm seeing here. Probably a lower quality to average quality company. Something to think about with those numbers. Now, what I want to see with return on equity is I always like to see 15% plus. This company hits that metric. They're getting sufficient return on equity. But what they're doing is they're turning a 7% return on invested capital into a 15% return on equity. How did they do that? Well, that's where all this debt comes in. So normally I'd like to see return on invested capital at 10% with return on equity of 15%. And that's a more palatable amount of leverage. The amount of leverage here is quite significant. Now, you are hitting the return on equity number, which is the number I care about, but the leverage here is quite big, and so it makes it a little riskier than a company that had less leverage. Now, where it gets really interesting is you start to see stuff like this. Price to book of 0.9, price to earnings of 12. Both these numbers suggest a really reasonable valuation, potentially an undervalued type company, because this is talking about an 8% earnings yield. You're paying book, and that book value is earning you 15% return on equity. So that's actually quite attractive. So you're saying, okay, well, on my book value, I'm doing quite well. So the valuation looks interesting despite the business quality looking poor. Now, what I find concerning, though, is when I see 10-year revenue growth of 11%, 10-year asset growth of 11%, and yet both free cash flow and earnings per share are doing worse than your revenue growth. This is reverse operating leverage. Your business is actually getting worse as you're growing. You'd like to see earnings and free cash flow growing at least in line with revenue or faster than revenue. So I don't really know why this is. It might be because they've had to increase leverage in order to gain that growth, and that's just a little concerning. But again, when you look at these numbers in the whole, they look pretty good. I mean, you've gone from $4.4 billion to $12 billion in revenue, although there's a big jump in 2017 to 2018. I'm thinking this probably has something to do with an acquisition. This doesn't look like normal growth for them, this 53% revenue growth. So that's going to impact some of these numbers, and it probably is going to impact the EPS and free cash flow because that's going to impact the number of shares outstanding if they had to issue shares for that operation. Now, if you ignore the volatility in these numbers, going from 0.62 to $1.54 in EPS is actually quite good for a decade. That's more than doubling. That's going to get you that like 10% rate of return. However, you were at $1.49 in 2013, and you're only at $1.54 today. You're basically flat over the course of 9 years, even if you're up more than double over 10 years. So this becomes really concerning. You're down from 2014, you're down from 2015, you're down from 2016. These numbers aren't stable enough to predict the future. This right here is a big concern because when you're trying to value a business, you need to be able to understand the future out 5, 10, 20 years. And it's really hard to do that when earnings jump around like this. So just something to be aware of if you're finding this company interesting so far, that's going to be a big concern for me at least, because I like to be very predictive of the future. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. And at the end of the video, I'll have a link to the full playlist where I've already covered 140 S&P 500 companies, and I think you'll really enjoy checking them out. So let's go to the income statement. See if we can figure out what's going on here with this business. Again, you see a big jump in SG&A in 2018. I think that's an acquisition. Here it is, though. Look at your shares outstanding. There's a big jump between these years. You went from 384 million shares outstanding to 498 million shares outstanding. That big jump is causing this massive change in EPS. It's driving the fact that the EPS is not growing as much. But even then, you have net income go from 943 million to $1 billion. This business isn't growing. Yes, you're growing your gross profit numbers, but where is it? It's not going to shareholders. It's going into SG&A. It's going into other operating expenses. Look, $5.5 billion. Your operating expenses have tripled, and yet your net income is flat. This is a failure of managing the business. I don't know what this $1.5 billion in billion shares outstanding was, but clearly there's something weird with the shares and the options that are being issued. See if we can tell what it is from the cash flow statement. There's certainly a lot of stock-based compensation. That doesn't surprise me. You can see acquisitions here with a big $8.5 billion acquisition here, which again, not surprising. So you're taking on a lot of debt, making a big acquisition. Lots of issuance of stock. Let's see, you see the goodwill jump here this year. You know, they bought a bunch of goodwill and intangible assets, which basically means they probably overpaid, because there's not a huge jump here. I mean, you make a really large jump in your assets, but then the profitability doesn't go up, and that's bad. That's really, really bad. It's hard to overstate that. Long-term debt is up over 3x. So again, your long-term debt's gone from $4.2 billion to $14 billion. You have $14 billion in long-term debt, and your earnings are flat. So $14 billion in debt compared to $1 billion in earnings. So you have 14 years of earnings to pay off that debt. 14 years of earnings to pay off the debt. You're paying $600 million a year in interest income. And that's at these low interest rates that we've had. So this is a really concerning debt level for a business of this size. I'd be concerned about investing in a business with this much leverage because it makes it, they're hanging on a nail thread. If their earnings drop just a very tiny amount, they could quickly become insolvent. So for me, Discovery is a company that I would avoid. It's extremely leveraged. If it grows, you could do really well because of that leverage. But if it doesn't grow, if it grows at this 1% amount, if it were to collapse in earnings for even a short period of time, you have major concerns. And I think the market is anticipating that with the way that the market cap is compared to its enterprise value. So for me, I avoid Discovery. If you enjoyed this video, hit that like button. Please subscribe. I'm covering new companies Monday, Wednesday, and Friday every week. you should be a subscriber so you can check it out. Help me to grow the channel. If you like this way of analyzing companies, if you want to use this software yourself, you can sign up at quickfs.net. The first link in the description below is my affiliate link. If you sign up for a free or a paid account through that link, it would be a great way to support the channel, help me to keep producing videos. I receive a commission when you sign up. Doesn't cost you anything to sign up using my link versus going directly to the website, but it's a great way to support the channel by using my link. Thank you for listening, and until next time, stop paying fees, start building wealth.